This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I'm your host, Scott Meyers, and today's guest is my good friend, Tim Bratz. Now, Tim and I met through a mastermind, and since the beginning, I have been extremely impressed by his rise in commercial real estate through his company, Legacy Wealth Holdings, that he launched in 2009. Prior to that, Tim began his career in New York City as a broker, leasing ground floor retail units. And it's through that experience where he began to see the true potential of how real estate transforms lives. And so he began his journey by reading numerous real estate books, attending workshops, and networking with a handful of accomplished entrepreneurs to help him launch his own business. He took that knowledge and then began building his real estate company in Charleston, South Carolina, where he relocated in search of a better quality of life. Arriving in 2008, after the real estate bubble burst, Tim quickly adapted and using a credit card, increased his limit, and then wrote himself a balance transfer check to acquire the cheapest property he could find. He then bought, transformed a rundown duplex, and sold it for a tidy profit on his very first deal. He then took those proceeds, reinvested them, and brought in private capital to expand his growing company. And today, Tim still uses this formula for success, which all starts with being resourceful and having the right mindset to continue to grow and scale his socially conscious commercial real estate company. So would you please help me welcome to the show my friend Tim Bratz. Hey, Tim, welcome to the show.
Excited to be here, man. Scott, thanks for having me.
Well, it's my pleasure, and sorry we didn't get a chance to spend too much time with each other when we were down at our mastermind in Florida, but I'm glad that we were able to, so that it just reminded us that I need to have you on the podcast to catch up a little bit on what you're doing out there.
Yeah, man. Well, I appreciate all the content and all the value that you're always putting out there, and have a ton of respect for what you have going on, so it's an honor to be here.
Well, and the same for you. And we're running in same circles, parallel circles, although you're on the multifamily side and I'm on the self-storage side. Mm-hmm. But at the end of the day, you know, I think we both agree that we're pretty much in the money business and we're raising capital and working with lenders and putting together a capital stack for an investment for us and our partners. You just chose a different asset class than what I'm working in. And so that's really where I wanted to head today. You know, I gave everybody a little information in your bio at the beginning of the show, but why don't you fill in the gaps and then tell us a little bit about what you're doing these days?
Yeah, absolutely. So high level, you know, one of the biggest questions I get is like, how'd you get started? So I was going through college 03 to 07, and everybody's making money in real estate 2003 to 2007. So I'm a money motivated kid at the age of 20 years old and decided I wanted to get involved in real estate. So when I graduated, my brother was living out in New York, so I moved out to New York City, and I thought you got involved in real estate by getting your real estate license. So I got my real estate license, somehow parked it with a commercial brokerage, and I did leasing for businesses. And, you know, I got kind of the bottom feeder type listings and brokered some stuff, but it took me about probably 7 or 8 months to close my first lease transaction. And a bottom of the barrel deal, a 400 square foot space on kind of like a side street in Greenwich Village, 400 square feet, rented it for $10,000 a month on a 12-year lease term with 4% annual increases. And I started doing the math on it. I was like, holy smokes, this landlord's going to make almost $2 million over the next 12 years for doing something once. And that's why I got involved in real estate, right? I wanted the residual income. So I quickly realized I need to be, you know, owning real estate instead of brokering real estate. So that's when I kind of went down the path of investment. And so I moved down to Charleston, South Carolina, and this is 2008, 2009 now. And the market completely collapsed. I found the cheapest house on the MLS, and I got my credit card limit increased, and I ended up buying that house, the cheapest house on the MLS, on my credit card, and physically did all the work. And in the matter of, I don't know, about 3-4 months, I sold it to one of the neighbors and made about $14,000. And I was like, I don't even know what the heck I'm doing. And this is supposed to be the worst real estate recession ever. And it's my first deal, and I'm a punk 23-year-old kid, and I just made the biggest check I've ever made, $14,000 at that time. And I was like, oh, let me go do it again. And then, you know, I got into wholesaling, I got into flipping, and I got into some creative financing type strategies. And essentially you start rubbing elbows because you're in the right circles with the right people. And you meet people with money, and they see that you got a good work ethic, and they see that, you do the right thing, and you're smart about how you're doing deals. And all of a sudden, people started reaching out to me saying, "Hey, man, I got money, but I don't have the time, or I don't have the bandwidth to take on more deals, or I don't have the expertise. And how about I put some money with you, and then we'll come up with some sort of an equity split?" And that's how I got my first private money lenders, and built up a small portfolio at the age of 25 years old, and had 10 doors. Wasn't rich, but I was technically financially free, right? I had more passive income. I would say it was residual income, right? Because I was personally managing my properties, but my residual income from these 10 units paid for all the operating expenses, paid for all the debt service, and put enough cash in my pocket to pay for all my personal expenses with a little bit left over, about $500 to $1,000 a month left over as well. And again, I wasn't rich, but I was technically financially free at the age of 25. And so I got it all figured out. Now I've got my walking around with my chest puffed out a little bit more, and I go and buy a Mercedes, and I join a private club, and then I blow all my money and chase some other shiny objects, sell my real estate, because I think I got it figured out, and I'm this hotshot entrepreneur, and I go completely broke by August of 2012. And so I had only my own personal home left, and I had $25,000 in credit card debt and $80 in my bank account, $80 cash, and I couldn't make the minimum payment on my credit card. What saved me from that is I had to sell my house, and real estate saved me. So I got back into real estate, and that's when I started buying apartment buildings. And so I found an 8-unit apartment building, I was flipping houses at the same time, and just realized I like the scale that multifamily had, and that's what I started focusing on. And I've been growing my portfolio ever since. And today, as I'm talking to you, I have 4,288 units, and 90% of my portfolio is apartments, and the other 10% is actually a little bit of self-storage, some office, and some vacation rentals as well. But really apartments are my forte.
Mm-hmm. So very similar to mine as well. My story as well. You realize you can't grow when you run out of cash. I mean, your growth is limited. Once you have the ability and you know how to put these things together and the capital stack, usually what's missing is the cash, and that's the way I started the syndication side as well, and also learned the hard lessons along the way. But tell me, if you would, for the other syndicators and promoters out there, and again, I'm curious for myself, as you know, Tim, I'm always asking people that are raising capital, how are they finding this environment? Call it the COVID environment, or since March, raising private equity has been a little bit different. And some folks are stating that it's a little more difficult. Others are saying it's been easier than ever. They just need more deals. So tell me what you've seen, say, over the past 6-8 months or so in the private equity world in the raises that you're doing.
Yeah, great question. I was in the middle of one of my biggest raises, a $10 million raise when COVID hit. And I raised $10 million. COVID legitimately hit a week later. And I had about 4 million of it, at least 4 or 5 million of it, fall out. Then I went and re-raised over the course of the next several months to get myself back up to $10 million. And it was very difficult at that time because there was so much uncertainty in the marketplace. Because people are like, hey, I don't know what's going to happen with my own business. Government's shutting things down. So now that we're past that, I found it's not difficult. It's just as back to business, right? People are realizing they got a good grip on this thing. They know what the government did, and how tight they tightened everything up, and how they closed everything down. And if it affected their business or didn't affect their business, I found that it's very much dependent on the business. And so the private money investors that I had in my syndications before, who have retail businesses, they're obviously spooked, and they're staying a little bit more liquid right now. But everybody else, and man, you've seen the numbers, like the economy's going crazy. My e-commerce friends are crushing it and have more money than they've ever had. Other businesses that I know that are in the tech industry and other real estate entrepreneurs are just crushing it with what's going on with the market, and they all have excess cash right now. And so there's a lot of money that's looking to be deployed into deals if there's good deals out there. So we're not having a difficult time raising money at all. Not right now, anyways. So really, exactly what you said before is like the issue is finding great deals. And if you can find some really good deals, it's not difficult to get them funded.
Mm-hmm. So what about on the lending side? We all know that the banks hit the pause button, as they normally do when there's something this cataclysmic that occurs in the economy. And so we had several of our projects that about 90 days or so were put on hold, and then the banks began lending again. And we found some new homes for some of our projects. We had to go to different banks, and then things began to open back up. But what we found, at least on the storage side, is that they were a little more conservative. So where it used to be 80%, they backed it down to 75, or 75 down to 70, and maybe given another half a point, or until we had the recent rate decrease. But debt coverage ratios, maybe they bump that up a little bit. So being a little extra conservative on the storage side, kind of the rule of fives, or 0.5% across the board, as we call it. What did you see on the multifamily side, and has there been a change as of late, like say within the past 2 months or so, if you've gone out and sought any funding from primary mortgage sources?
Yeah, very familiar. So my business model is I buy distressed assets. So I buy distressed apartment buildings that are physically distressed, or they have poor management in place, and they're usually not in a position to get long-term, non-recourse agency debt from Fannie Mae, Freddie Mac, CMBS, or life insurance companies. So because I go through bridge lenders primarily and local banks, that's who was really adversely affected by this whole thing, and they all but shut down. So that was really, really tough for us, and we had to walk away from a couple of projects because of that. But we opened up some new relationships, which actually was pretty nice. Some of the local banks are lending us more money now. Some of the local banks are not lending at all anymore, and they're just in asset management type mode right now. So it just kind of depends, I think, on the lender. A lot of the bridge lenders and the debt funds have come back out of the woodwork, and they realize, okay, their issue was like nobody was buying the paper on the back end, and now that that's happening again, they're okay. But over the past couple of months, like I refinanced 1, 2, 3, 4, 5, 6, 7 buildings over the past 2 months. And definitely exactly what you're seeing, we're seeing a lot of the same thing. The issue that we've really been coming across, the biggest issue for us, is we were at pretty low basis on our properties. And they were like, we had some big cash out refis that we had our eyes on. And we were all excited, dollar signs, that we're seeing. And then all of a sudden this stuff hit. And exactly what you said is, the rates are amazing. It's like almost free money. Like we're getting, low 3% interest rates. 3.25 to 3.5 is where most of mine have been landing recently, based on the size of the deals that I've been refinancing. And but the LTVs are coming back a little bit less. Some of them actually haven't been too bad. But although the appraisals, you would think the values would be high because rates are low, cap rates are low, and values are in inverse relationship to cap rates. You would think the values would come back high. They're still being a little bit more conservative on the appraisals. So they're coming back a little bit more conservative. Maybe the LTVs are dropping. We've only had that come across on a couple of deals, but most of them have been pretty much where we expected them to be. But the big thing is these escrow holds. So I don't know if you guys have that in the storage side of things, but they're making us escrow at least a year's worth of principal and interest on the properties. They're making us fund a year's worth of capital expense for the CapEx account, and they're making us pay a year's worth of insurance up front and a year's worth of taxes up front. So all of a sudden, we were expecting these $500,000 cash outs and $2 million cash outs, and all of a sudden, we're only able to get, we're at break even and can barely pay our investors back. Now, the money's still there, right? And we're going to have excess cash flow over the next 12 months, and then they'll release any of the reserves over the next 12 months. But it's definitely, adversely affected the cash out refi. But I will say this: if that's the worst case scenario, we're in a pretty damn good scenario, right? Like we still have amazing terms, amazing rates. The money's still there. The values are still there. Tenants are paying, and we will have access to that money. It's just taking a little bit longer to pull it out. So we're seeing a lot of strength there, and because of what's happened in a lot of these markets, especially like the blue states, they're so tenant friendly, and they're even more tenant friendly because of what's happening with COVID. Tenants aren't getting kicked out, and these landlords are getting hosed. And it's been 9 months, and they haven't been able to kick somebody out for paying. And all of a sudden, these tenants, some of them are gaming the system, and they're having a really, really tough time in New York and Washington State and California. And so they're coming into the markets and bringing their investment dollars into markets like the Southeast, where I'm really heavy, in Georgia and South Carolina and Alabama and Louisiana, North Carolina. And they're coming in and they're buying at cap rates that are more Northeast kind of cap rates. And so now they're coming in and they're pushing up the values of my properties, of the, things that I didn't think would sell at that price point for at least another 5 years, I'm getting today. So that's why I'm actually in the process of selling about half my portfolio. I got about almost $200 million of property under contract right now because of all this money coming out of the Northeast. So we're going to end up selling a bunch of stuff, and because I'm in education just like you are, there's a lot of deal flow that comes from that. We're going to be able to source some new opportunities, maybe a little bit better markets or better areas, nicer assets, maybe do some development side of things, and roll a lot of our gains into newer, bigger opportunities.
Mm-hmm. No, smart move. I think when you see interest rates, and like you said, cap rates are lagging a little bit behind in terms of the value, and some of these appraisals are being conservative. And I think the appraisers have learned through '08, if they're around then, or any time that we have a hiccup in the market, if they want to save their jobs, they just need to be conservative regardless. But
sure.
we have seen, we just got an appraisal on a project, $3 million is what we have it under contract for, and the appraisal come in at 3.3. And that's pretty rare that they would go above the purchase agreement, and they had access to that as well.
Especially on the acquisition, yeah.
Oh man! So a couple of things that you had mentioned, I want to comment on, and then I have a question for you, and that is, we've seen the same on the storage side in terms of banks holding back, in a refi. But we're in a refi right now. Just got a term sheet also this morning, and they're holding back a portion of the funds from the refi. And there's certain things we haven't had to fund a year's P&L or taxes. I can see where they may charge taxes, but a year's worth of P&L, sorry about that one. That stinks. But we've had, they're holding back our fees, and so we take a capital raise fee, and we take asset management fees and others. And so any chance that they can get to say, no, Scott, we're not going to allow you to pay yourself from this project for this or that, and they'll peel out anything and everything that they can. And yes, they've asked us for some capex, or they've just held some in escrow period. Just a flat dollar amount that says we're going to hold this back for operating reserves, and they don't name it what it is specifically by line item. So, and I get that. Forced accountability and budgeting is probably not a bad thing for some folks. I don't think we need it, but nevertheless, it keeps us all safe. So I wanted to ask a question. You touched on, the blue states and some of the challenges that the landlords have there, and that they can't get these folks out, and their values are declining because the valuations are based on an NOI. Now, there's one syndicator that invests in work housing and multifamily and different types of commercial asset classes, somebody you and I both know, and he says that he won't step foot into a blue state, period. He said he doesn't want to operate that way, go into that environment, and he has a tougher time getting in his investor partners to do the same. So I would ask you, are you looking, how opportunistic are you looking when you are going to refinance, recapitalize? Would you go into these blue states and realize that COVID thing, this is temporary, and that perhaps you can pick up some of these distressed properties? I think you may have alluded to that, but tell me your thoughts on that, Tim. What does that look like?
Yeah, I think from a standpoint of multifamily, I would not. I think it's a different asset class. You can go find some home run deals on office or retail or hospitality or storage. I would be more inclined to invest in a blue state for something like that. Like I'm developing actually 800 units in New Jersey self-storage facility, because even though it's more of a blue state, that's not the landlord tenant laws for storage. Nobody's living there, so you have a little bit easier of a way to get people out of the property if that's the case, if they don't pay. Versus residential, there's this tug on the heartstrings type feeling where the judge doesn't want to kick somebody out because they're facing hardship, whether that's real hardship or perceived hardship. On the residential side, even the red states are a little bit tougher to evict people right now because of everything that's going on. So I would not go into a blue state from a residential standpoint, mostly because I'm just not familiar, and I'm not familiar. I don't buy, never bought anything in Massachusetts or in New York City from a residential standpoint before. But I would look at other commercial asset classes there. But I'm more familiar, and I just like the laws and the landlord tenant laws, down in the southeast, and that's what I just focus on. I stick to more those areas that I really, really, really know, and I feel comfortable with it. So yeah, I'm sticking to the southeast for now.
Mm-hmm. So that brings up my next question. You and I, we both consult, we educate folks, and that gives us opportunities to partner on some projects if we're consulting and helping folks along. And so that usually is what brings us into a market. We aren't doing a lot of outbound marketing into a particular market like you had mentioned, so geographically. So
Mm-hmm.
are you doing that as well? I know that's where you're focusing, or if the folks that you're
Yeah.
working with in consulting, are they taking you into other areas and markets, or are you just saying no to the markets in which you don't feel comfortable in?
Yeah, we're in 12 different states, and most of our deals come from joint venture partners or students who are either wholesaling us the deal or joint venturing with us. And so we will go into a lot of those different states. If it comes in from a blue state, again, on a multifamily side, we typically say, hey, it's just not a good fit for us. Post it in the Facebook group or something for our coaching, and somebody else might jump on it. But if it's coming in from an area that we already own some property, or it's a state that we'd be open to going into, absolutely we'll take a look at it. We have a much stricter buy box now, and I think we all go through that process, not only because of COVID. COVID definitely tightened it up a little bit. We're not doing as heavy of value adds. Now we're looking for something that's kind of moderately light value add, medium value add, instead of a heavy value add. A little bit higher occupancy, with just some room to bump up rent, instead of having to do like a whole turnover of the entire complex. So we've changed from that capacity. But I think as your portfolio grows and you start, realizing, hey, I don't need to do, like, I'm selling all my smaller apartment buildings. Anything that's under 80 units right now, I'm selling. Just because it doesn't have the efficiencies. It got me to where I am, so I'm thankful for that, but I don't need it right now because I can sell that off and I can focus on some bigger opportunities. So I think, as I've grown my portfolio, I always take a few steps forward, and I might take one step back, just refinement, and then I take another few steps forward, a step back, a few steps forward. And that's kind of what I'm doing right now with the sale of the $200 million worth of property. Selling more the C plus B minus type of properties in tertiary markets, and I'm focused on more primary, secondary markets and A minus, B plus kind of areas. And so that's kind of what we're going through right now. And now our students know that that's what we're buying. So anything that comes across our desk in those areas, we'll be involved with. But we also do some mentorship type stuff where we're not raising money or doing anything. It's just great operators bringing deals in their own backyard, and they say, hey, I got the money. I got the balance sheet. I can get the loan. I can operate this thing. I found it. I just don't want to fall on my face, Tim. And I know you guys don't partner on anything in Connecticut, but I'll handle everything. Can I just give you some equity to mentor me and coach me through it? And I love that kind of deal, right? I have zero risk. I can just bring my team and our mentorship and all of our resources and all of our connections and all of our experience to that deal and help somebody else feel the confidence. And they know the local laws. They know the local lay of the land kind of thing, where they can go and operate it. And I'll do those kinds of deals anywhere, right? Because I don't have any personal financial risk into it, neither do my investors. So we'll get into some of those markets for that reason. But for the most part, we're sticking to our buy box, which is primarily the Southeast, 100 plus units, A or B class kind of areas, workforce housing. We don't do anything luxury, and primary, secondary type markets. And that's really, really what we're looking for right now.
No, that's really good, and we appreciate that, as well as when we have our joint venture partners that come to us and they want our expertise and or private equity and many times our Rolodex, as you mentioned. And there are folks out there that either they stumble upon a deal, maybe they're still they're still pretty savvy, but they can't put everything together. And I both know it takes years to build a good team. I mean, I've been at this for 15 years in storage and 25 in real estate, and it's a finely tuned team right now, and some players come and some players go. But gosh, it took me a good 7 years before I got a rock solid team of rock stars on this. And so, yeah, I think that's a fantastic scenario. And quite honestly, I don't know why anybody that's on the other side would try to navigate through that risk, losing the deal for not getting it across the finish line to begin with, but then making the mistakes along the way at the power of a 7 cap or a 6 cap, you don't need to make too many of those before, you're losing money on those projects. So kudos to you. So that being said, let's talk a little bit about, what that deal structure looks like when somebody comes to you. What is that? And more specifically with the management side, because I think that's where we shine as asset managers and working with management companies. So talk to us a little bit, if you would, about what does the management structure look like? Are you using third-party property management companies, and then you are the asset manager overseeing them, managing the management companies? Do you have a portion of that in-house? How are you driving
great
NOI
question.
once you get into all the partnerships?
So we've done both. We've done it. My team is headquartered up in Cleveland. I used to be in the turnkey space also. So we were doing 80 to 100 houses a year for a few years there, from 2015 to 2017, until I went all in on apartments. And we built up a management company, and we were self-managing all of our apartment buildings up in Cleveland. We still are. Same thing with my stuff down in Georgia, and then I don't know, the other 10 states where I own property, we've used third-party management. I think what I've realized is the biggest bottleneck in doing volume in a lot of deals is typically boots on the ground, operations, project management, coming in, kicking the table, making sure contractors are doing what they're supposed to be doing, property management. Like that's a bottleneck, and you're limited by how much bandwidth that you have. And so realizing that there's a lot of scale in raising money one time and having equity in perpetuity in that deal, sourcing a deal one time and having equity in perpetuity in that deal, mentoring, coaching one time, or something that can be done remotely, or something that can be done at scale, and having equity in a deal in perpetuity, like sponsoring the loan one time and having equity in perpetuity. Those are the kinds of things I'm looking to spend more of my time on now, because there's more scale to it. And then we're not bottlenecked like we have been with operations. So I'm always looking to partner with amazing operators, project managers, people who can manage construction, and they're just looking for somebody with a balance sheet. They're looking for somebody who can bring some money. They're looking for somebody who can mentor and coach them. And then I bring in some of those partners, or I use third-party vendors to handle a lot of that stuff. And as you know, being in commercial, you're working with more sophisticated vendors typically than you are in the residential world with, Billy Bob and two guys in the back of his pickup truck who just show up or don't show up, as you schedule them. So because we're working with bigger projects, we're working with contractors and construction companies that actually have some level of sophistication and know how to not just swing a hammer, but actually operate a business. And so they're accountable. They'll give you a not to exceed bid. They'll give you a timeline. There's a contract in place, but if they don't hit that timeline, there's, financial repercussions that are involved in that. And so I like staffing all that out. I don't want my team handling that because it's not the scalable portion. And if we are growth oriented, which we very much are, I want to make sure my team is doing the things that can scale. So we like sourcing deals. We like raising money. We like sponsoring loans. We like being involved from a mentorship standpoint. And then what we like to do, even my stuff that's local in Cleveland, we are bringing in third-party management, so it doesn't take my team away from doing, just higher return on investment, higher return on time type activities. I want them more asset managing, not property managing. That's it's a big bottleneck, it's a big choke point in all real estate. And so the more I can remove my COO from that, and we're going through this process, so it's a very timely question, Scott. We're going through that process up in Cleveland right now, selling some of my properties, and then anything that we're keeping, we're putting third-party management on. Even though we can easily manage it ourselves, the opportunity cost that it takes my COO away from doing more deals, bigger deals, and building more wealth for our organization, that's greater than the money that we might save on managing this stuff ourselves. So I want my team out of doing property management and into doing just asset management, which can be done remotely from anywhere in the world.
Yep, agreed. And the interesting thing is that when we look at our third-party property management companies, the performance of the facility is really dependent upon that regional supervisor that oversees and hires and
Mm-hmm.
trains the person that is sitting behind the desk at the actual asset at the property level. And so if you take that approach, if you hire a good property management company, we have really good asset managers. And so same as you, I'm eliminating anything that I can't scale in my business. We utilize third property management companies, but we act as our own regional supervisor, even though they have one. I get that,
Mm-hmm.
but we oversee them and then make sure that they are on it, and then doing our audits and doing everything else that a regional supervisor would do. But I do that with one or two people, and they do that for us nationwide in the states that we operate in. So, with that, we're in that same position. Sorry, go ahead.
No, I was going to say we do something very, very similar where any of the third-party stuff, we have our on-site property manager and maintenance staff, leasing agents, and then we have a regional manager, which is a third-party management. So if somebody needs to be fired or a decision needs to be made on a property level, they're going to the third-party regional manager first, and then it comes up to my COO, who's the asset manager. And so my COO runs a phone call every Monday for 15 minutes on every single one of our properties, and he spends the entire Monday just hitting on KPIs across the board. And if one of the metrics does not equate the right way, then he gets on another phone call later on a Monday or Tuesday later on in the week in order to make sure that everything is cleaned up. But we're not very good passive partners or passive owners. We are very active in what we do and keeping an eye on stuff. So we're taking a look at all the KPIs on a weekly basis, so that way we're not surprised when the monthly statement comes out at the end of the month.
Yep. Yeah, we made a lot of friends in the third-party property management world, and there's some folks that that can't work with us because we take that same approach. But when our investors' money is on the line, irregardless of ours and our profit, then that we take things pretty seriously, and they better live up to what they had promised us in the beginning. And there's no recasting budgets because the market didn't support it. These are the numbers that you set, and if you're not making it, then not going to be around. So as we are pruning all things in 2021 that can't scale, to your point as well, tell us what things look like. What is the biggest, I don't know, call it goal setting. I know you're probably in that state as well as we're heading into 2021. What are some of the things on the pipeline, and what are you seeing in your crystal ball that you want to be opportunistic about in the storage or the multifamily world heading into the next year?
Yeah, man. I mean, that's $1 million question, right? It could be a $100 million question if it's answered the right way. I mean, for me, there's a lot of speculation, and if you talk to some of these economists and speculators a year ago and what they were saying about what's going to happen in 2020, 100% of them would have been wrong. And so looking at that, nobody's got a crystal ball, and I wish I did, but I'm a believer in you just do good deals. If you have a great investment strategy and great business formula, it doesn't matter if the market's up or the market's down, there are going to be good deals. And there were good deals a year ago, there's good deals today, and there's going to be good deals a year from now. There were bad deals a year ago, there's bad deals today, and there's going to be bad deals a year from now. So I think it depends more on what is your investment strategy and how do you just source more deals? How can you get more volume of opportunity coming into your pipeline? And then you sort through more deals. And the more quantity leads to higher quality. You can cherry pick the best deals that come into your pipeline that way. So I'm focused more, less on things that I cannot control and more on things that I can control. And that's just sourcing boatloads of deals. How do you source boatloads of deals? I'm very active on social media. I'm very active in my coaching platform. I'm very active in our outbound marketing. And so that way we have a ton of deal flow coming in, and then we can sort through it. Again, cherry pick the best ones, close on those, and that way we know we're doing good deals. And, I'm not trying to time the market. I'm not Nostradamus. I don't know what's going to happen next year. But I know baseball games are won through base hits, right? Not necessarily through home runs. The more base hits you get, and then all of a sudden, if I can come across a double or a triple or a home run or a grand slam, God willing, that's amazing. I'm looking for just deal after deal after deal, and I'm building the portfolio, and some of them are going to turn into home runs. just because we're doing good deals. I mean, we do all the right things. We buy at a wholesale price. We create appreciation by putting sweat equity into the property. We don't speculate on anything. We buy for cash flow. We're stress testing the numbers. We are trying to kill deals more than we're trying to make deals happen. And if you're trying to kill a deal and you're using a lower loan to value, and you're using a higher interest rate, and you're using lower rents than you think you can get, and you're just stress testing it all these different ways, and it does not kill the deal, and you can't kill it, that's when you know it's a really good deal. And so regardless of what's happening with the market, if it meets all of those we can check all those different boxes, we're going to take that deal down. And even with everything that's happened with COVID, we still picked up, 900 units, I think, this year. So we were still very active in acquisition, despite what was going on with all the uncertainty in the marketplace, because we came across great deals. And I'm not going to pass those up. Money is almost free right now. So the great thing about what we do is we're in the cash flow game. And even if values drop to zero, if you have enough cash flow coming in on your assets that covers all the operating expenses, it covers all the debt service, and puts cash in your pocket, Scott, you and I both know that there's still value to that. And we can at least ride out the storm, however long that storm lasts, and just sit on the cash flow. That's a pretty good worst case scenario until the market bounces back, and then you can refinance it, or you can sell it, or you can get creative on the exit strategy. There's a lot of different opportunities there.
And that's the reason why we are investing in a hard asset that produces income, because stocks go down in value in mutual funds and they don't produce cash flow. And so another reason why people are always exiting and continue to exit the stock market and trying to ride that cycle. Whereas if, again, you got bricks and mortar or something that produces cash flow, it does have some value to it if it's covering all of its expenses. And if you bought it right, it should anyway. So Tim, once again, we could talk for hours, and sorry it's taken so long to get you on the show, but I'm glad that we had the time to do so. Appreciate you taking the time from a busy schedule. Everybody's, cramming things in at the end of the year as we're heading into 2021 as well. But it's been a pleasure to have you on the show. If you would, tell us, give us a nugget, either one of the best books you've read recently, or perhaps even some good advice that you could share with our folks. And then tell us how we can get in touch with you, and we'll wrap it up.
Yeah, man. Well, thanks again for having me. I always enjoy our conversations, and you're one of those guys that thinks at a super high level, and I love surrounding myself with people like you. And I think that would probably be the nugget, right? It would be, make sure you're in the right rooms. If there's anything that you're doing in 2021 that's going to change your trajectory of success, it's surrounding yourself with the right people. And whether that's mentors or I'm a big believer in mastermind groups. So if you can get into a mastermind group where there's multiple mentors there, you got to be around the right people, right? Like, we all know that you are the average of the 5 people you hang out with, but I don't know if people really, like, we've heard it before, but I don't know if people really understand that until they get into these rooms. And it's not only about getting into those rooms and surrounding yourself with the right people, but you also have to disassociate, or at least reduce your association with people who are not have a common future with you, right? And people who aren't in a goal-oriented, progress-oriented type state of mind. Like, you create more of a spread of success by eliminating the things that are holding you back and adding the things that can propel you forward. So I'd focus on that. I'd make sure that you're in the right rooms with the right people. Surround yourself with people who are where you want to be, and they're supportive of you. They believe in you. They believe in your dreams. They believe in your goals. They're connecting you with the resources. They're abundant-minded, not scarcity-minded. That has made a world of difference for me in my success and my trajectory over the past several years. So I believe heavily in masterminds and just surround myself with the right people. And you'd be amazed. And here's one last nugget is a lot of us are doing goal setting right now, as you alluded to, Scott, including myself. And all of us, every single one of us, will overestimate what we can accomplish in the next 12 months. Mm-hmm. That's pretty much a standard across the board. We all think we can accomplish more in the next 12 months than we usually can. That's okay. I will also say this, though. we all grossly underestimate what we can accomplish in the next 3 to 5 years. And if you just keep your head down and you start building up momentum, I don't even set goals more than 3 years out anymore because they change so quickly with the opportunities that present themselves. Based on once you catch momentum, it is a powerful force. And if you would ask me 5 years ago if I'd owned $350 million worth of property and over 4,000 apartments, I'd be like, hey, maybe one day, maybe when I retire when I'm 60 years old, let alone could I do it in the next 4 or 5 years? Like, I wouldn't have believed you, but it's just the power of momentum. So don't be discouraged if you don't hit your 12-month goals. Keep your head down. Don't look left. Don't look right. Know exactly what you want. Keep on, moving the needle forward. And all of a sudden, that compound effect, that snowball effect will set in. And you're going to be amazed at what you can accomplish by doing the right activities and surrounding yourself with the right people over the next 3 to 5 years.
Fantastic advice, and agree 100%, Tim. And, I think it was Jim Rohn who said, not only do you need to surround yourself with good people, and everybody knows that we are the sum total of the 5 people we spend the most time with, but yeah, you need to weed the garden, and that means get the people out of your life that may be around you that aren't edifying you and lifting you up and having the same goals or greater than you. So sound advice. All right, Tim, if people want to follow you, how do they find you on the socials?
Yeah, I appreciate that. Connect with me on Facebook. I'm very active on Facebook and Instagram. Those two, send me a friend request or click me a follow on Instagram. And I'm always trying to, create value and put some nuggets out there and try to help people. I truly believe that, wealth is like sunshine, and there's an abundance of it. And, you getting sunshine doesn't take any sunshine away from me. So might as well share the love. So I'm always trying to put stuff out there and create value any way that I can. So, man, again, thanks so much for having me, Scott. You always ask awesome questions and stimulate amazing conversations. So, again, ton of respect for you and what you have going on, and really appreciate you, man. Thank you for the business relationship and the friendship.
Well, it's my pleasure, and it was good to connect once again. I appreciate your time and value everything that you're doing for the community as well. So with that, my friend, looking forward to the time when we can get together again live, hopefully sometime soon here. So with that, have a happy holidays, and appreciate you, brother.
You too, man. Thank you.
Take care. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.